Over half of the income tax returns filed for financial year 18-19 are filed by salaried individuals, that is ITR 1. Let's understand what is salary income and how it's taxed. First, let's take a look at how is CTC different from take-home salary. CTC is the cost company bears for an employee. It includes the basic salary. This is the primary element of your salary and the basis for other components. Your basic salary is fully taxable. You may also receive other allowances and special benefits as part of your salary, like HRA, that is the house rent allowance, which is paid to cover the house rent expense. HRA is partly exempt. Lower of the following will be exempt from taxes. However, in case no rent is paid, HRA is fully taxable. For instance, if you own a primary residence. Conveyance allowance is paid to help meet expenditure like commute between home and work. The exemption is equal to the expenditure incurred. Government employees also receive Dearness Allowance to compensate for inflation. This is fully taxable. Your employer may also give you leave and travel allowance to take a trip within India twice in a block of 4 years. The exemption is allowed for the actual expenditure incurred on the trip subject to certain limits. Medical expenditure and transport allowance are discontinued after financial year 18-19, and standard deduction up to Rs 50,000 is allowed for salaried individuals. Finally, as part of your salary, you may receive perquisites and bonuses, which are fully taxable. Now that we understand components that make up your CTC, let's take a look at what is deducted from CTC to arrive at your take-home salary. TDS or tax deducted at source. As per the declaration you make using Form 12BB, your employer calculates your total taxable income and deducts TDS as per the applicable income tax slab rate. TDS is deducted every month from your salary. Professional tax is also deducted every month and paid to the state government as an employment tax. Finally, EPF or Employees Provident Fund. Employers with more than 20 employees are required to contribute towards EPF. All the components and deductions are reflected in your salary slip. Salary slips are generated and given every month by the employer. At the end of the financial year, the employer uses salary details along with the investment declarations to file TDS return, that is Form 24Q, which in turn is used to generate your Form 16. In case you switch jobs or have more than one employer, you may receive multiple Form 16s. Let's take a look at Budget 2020's impact on salaried individuals. Allowances are taxable under the new income tax regime. However, they are still exempt if you opt for the old income tax regime. Under the new income tax regime, you cannot claim any Chapter 6A deductions, whereas you can continue to claim all Chapter 6A deductions under the old income tax regime. Individuals having salary income can file ITR 1. The due date to file ITR 1 is 31st July. You can use your Form 16s to file your income tax return. Subscribe to our YouTube channel for more such videos. We are Quicko on a mission to simplify taxes for all.